and it's going to be great. So I'm really excited about that. Some really fun things to come. But today we're going to look at what the heck is happening with rates, what's going to happen this year, and then go over the forecast. The Fed's involvement this year is going to be extremely important. But I want to kind of go over kind of what's happening right now with interest rates, because a lot of you have seen interest rates kind of spike up a little bit. So I want to go over that with you in a little bit more detail. So shared on the screen right now is, I think you can see the mortgage-backed securities trends and what the mortgage-backed securities have done over the last, well, since before the pandemic. So if you look on the far left of this chart, this is what mortgage bonds have done since way back here in February. So we're going to do a 2-year look. So we had rates right here, which are the rates right now. If you look at the mortgage-backed securities right now on the far right, on the very bottom on that candlestick, all the way to the left, we're exactly the same as where we were February of 2020. So we had a nice run. Mortgage-backed securities went all the way up to the 105.563. That was back in January of 2021, when rates were at the lowest point they've ever been. And then we saw some deterioration. We've got a lot of scares with inflation, which we'll talk about in a little bit more detail. And then we see this run down. And now if you look at this, I mean, this is a pretty straight, I mean, this line downward is a pretty significant line downward. And that is all thanks to inflation. Remember, inflation is the enemy of interest rates. So I want to show you kind of where we are in the last week. So let's go to that real fast. So this right here is what's happened this week. We have lost. So if we started here at this alert that was locked, see, we were at about 102.25. Now we're at 100.5. So we lost 200 basis points of rates in the last week. So what that equates to somebody having a rate of 3% with no points, being quoted that back then. That same rate now costs 2 points. So it's been a significant run. I'm going to show mortgagenewsdaily.com. I like to go here just to give you what the average is on interest rates right now. Oh, they changed their format. But here's the daily rate survey. Now we're at 3.5 on an average interest rate on a standard 30-year fixed without any points. 15's at 2.77, so you can still get in the twos. FHA always has better rates than conventional, so they're about the 3.1. Jumbo's in the 3.25 range. And if you want an adjustable rate, look at the adjustable rate mortgages. It's an inverse yield curve, meaning short-term money is actually more expensive than long-term money. So very interesting. But as you can see, the deterioration of the markets continues based on inflation. Now, we expect the deterioration to continue until the Feds intervene. The Feds aren't really going to intervene and start their tapering or start their plan, so to speak, with raising interest rates until March. So we have to look at, okay, well, what's that going to look like? I do think rates, well, let's just jump right into it. Hold on one second. Let me get to the PowerPoint and we'll start from the beginning. So forecast, where are we looking? What is going to happen? Let's look first off for some changes. We've seen a lot of changes in loan amounts. So let's look at FHA depending on your county. Now the loan limits for FHA for 2022 for Coconino County, they've gone up on a single unit to $423,200. Yavapai, we're at $420,680, and Maricopa, we're at $441,600. So this number is based on the median average of what homes are selling for in that area. So that's where this number is derived from. And if you guys aren't muted, make sure you're muting just so that we can't hear you guys talk in the background.
Of course.
Oh, okay.
Yeah.
That's okay. No, I'll walk him up to Happy Valley.
I wouldn't even go that far. I just take him up for a short walk.
I will go out there.
There we go. I muted them for him. All right. So now we're looking at, hold on, let me pull up my marker. So 441,600 for Maricopa County. And let's go to the next slide and we'll see what conventional has done. So all counties are going to be the same. 647,200 is the new minimum for conventional financing nationwide. I'm sorry, nationwide, Arizona wide. So it has gone up over almost $100,000, guys. So that is a really big boost to be able to manage the pricing that we've seen as far as the increase, to allow more people to avoid the jumbo markets. Whoop, where'd it go? Sorry, technical difficulties. There we go. And so as far as what we're seeing in interest rates going up and prices going up, overall, it's just more expensive. So let's kind of see what, sorry about that, guys. So more 2022 changes that we're going to see. And again, this is not good news, really. The GSEs, now, if you ever hear that word GSE, a GSE is basically a government-sponsored entity or enterprise. Fannie Mae and Freddie Mac are GSEs. So anytime you hear in the news talk of GSEs, that's what that is. So coming up, and this is April 1st of this year, so a happy April Fool's gift. Whoop. We have two things happening. Second homes are going to have an increase in fees from 1.125 to 3.875%.
Hey, Sean, Sean,
Yes.
we can't see your screen.
Oh, I'm so sorry, guys. There you go.
Yes, thank you.
Technology, I appreciate that. So the GSEs, the government-sponsored entities or enterprises, are raising the rates and the cost on second homes again. They did this back during the middle of the pandemic and then they took it away. Well, they're adding it back in. I think they liked the money that they were getting. So second home purchases are going to have a 1.125 points to 3.875 points added to the cost of the loans. So you could probably expect anywhere between 1/4 to 3/4 higher in rate in second homes starting April 1st of this year. So I think the Fannie and Freddie's getting a little greedy on this. I'm not sure what their play is on trying to do this, but it's not good because we have a big second home market here in Arizona. So this is going to make it more expensive for buyers. So if you have somebody that's on the fence, we need to get them off the fence and get them shopping right away, because come April 1st, those costs are going to be input into those pricings, into the rates for mortgages moving forward. Now for high balance loans, you may hear this term. This is more for, it's not really in Arizona, but California, some other states have high balance. It's just a bridge between, it's just a bigger conventional loan, sometimes up to 900,000. So don't worry about that for here. But if you're in California market, that's an increase that's going to be happening. And so what is going to happen with the feds? So the Fed is going to play a huge role this year. Tapering, rate hikes, and balance sheet runoff are their tools that they're going to be using. This is really going to help interest rates once they start, but until then, it's going to be tough. Equity markets, you saw today, it's a little bit of a bloodbath. Inflation is the enemy of interest rates, guys. So I say for the next couple months, it's going to be a little tough, a little rough, but there will be potential to refinance towards the end of the year. So if people are saying, I'm afraid, I'm not going to buy right now, tell them buy now, because appreciation is still happening. But interest rates, you can always refinance once there's a down draw. And I do believe there will be a down draw towards the end of the year and into next year. But for now, inflation is the enemy, and the Fed hopefully will start interceding. But let's kind of look to what they're going to be doing. So some Fed vote members rotate each year. It's really going to be a little bit different. Inflation is the major focus. And if we see a little bit more bleeding in the stock market, you may see them intercede even more. We all think that the Fed should have hiked rates sooner, but they thought that inflation was transitory, and it unfortunately is not. So it's here to stay until the Feds intervene. So let's look a little bit about history to see what's going to happen. So history, Arthur Burns he was the Fed chair back in the 70s. He ignored inflation, which was rising rapidly, and guess what? He said it was transitory. So that was the term that he used back then. And then it went from 7% inflation to 14% in the 1980s. So what's kind of scary is the terminology that they used was very similar to the terminology that was used this last 6 months as it being transitory. But they were resilient. They thought it was going to be transitory or transient, and it wasn't. So mortgage rates rose about 6% because of that. Now, we don't foresee it going that crazy, but let's look at the 80s, what they did. So Paul Volcker hiked the Fed funds rate almost immediately, and from 11% to 20% in 2 years to offset the inflation. And then inflation dropped from 14 to 5. So you can see how the Fed funds rate, raising that up, kind of slows down everything, drops inflation down, and kind of gets it in within order. That's why I'm expecting once the Feds do intercede, starting in March, I think rates will be a little bit lower then. So it's interesting to see how the different Fed chairs do things. But as you can see, whenever there's a rise in interest rates on the Fed to offset inflation, you can see what happens to the stock market. Usually it drops pretty significantly. So we really need to watch that, guys. So Alan Greenspan in the 90s, inflation doubled from 1.75 to 3.5%. Keep in mind, guys, we're right now touching into the 7% level in inflation. So that caused interest rates to rise from 7 to 8.5. So not a lot, but they took action mid 90s, and we saw the Fed funds go up to 6.5, and then inflation responded and dropped to 3.5 towards 1%, and that's when rates drop back down again. So raising the Fed funds rate, guys, helps inflation, and it actually will help draw interest rates on mortgages lower. So when people hear the Feds are going to be raising rates, it does not translate to mortgage rates. That's one of the key points I want to make sure we're making here. So when you're talking to your customers and they're like, I want to buy before the rates go up, good, that's good. But if they think that the Feds are going to raise the rates and they're worried about that, let them know the Feds raising the rates this time will actually help inflation, which should draw interest rates on mortgages lower. So that's a key point when talking to your customers. But when they did it last time, stock market actually dropped almost 50%. So there's a lot going on there. That wasn't just the Fed's action that made the stock market move, but it's interesting how the numbers worked. Now, Jerome Powell, he's our Fed chair now. Again, inflation increased from 1.75 to 7. That has been this last run in this last 10 months, so to speak. So we went from 2.5 to 3.375. Now we're up to 3.5. He is going to start tapering. So the Feds have been buying mortgage-backed securities at a tune of about 40 billion a month for a long time.
10%.
I'm sorry, 40 billion a day for a long time. So they are going to stop that. They're going to raise interest rates, and that could bring us down to the target inflation rate. But it could have an impact on the stock market, which right now we're seeing a little bit of volatility in it as we speak. So let's recap. See a pattern kind of a thing. The Fed chair, inflation, what they did, the response led to a recession. Alan Greenspan, high interest rates, inflation, raised rates to offset inflation led to a recession. Jerome Powell, same kind of thing. We believe there will be a recession. Now, recession is not a bad word for real estate, but it could be in regards to jobs. And the reason it's not bad for real estate is when people lose their jobs, they move around, they have to sell. The numbers on real estate transactions during a recession is actually very similar to it during other times. It's just people are moving for different reasons. So yes, it's bad for the economy. Interest rates will be lower in a recession. Real estate is not going to be hurt. Now we could see a slowdown, which we'll go over in a little bit in appreciation, but it's not going to be the end of the world, guys. Now COVID is a major wild card, right? We don't know every day what new thing is going to be happening, in the last 3 weeks in my office, everyone except for me has gotten COVID. So it does have an impact. It has an impact on supply chain. It has an impact on the cost of goods and the cost of delivery. It has an impact on everything. So we can't avoid the wild card that this could do, that this could impact our markets with. So additional stimulus, guys, is just going to fan the flames of inflation. So I really don't want any more stimulus in this economy because it will hurt. It'll make inflation even stronger. And it'll cause rates to go up any higher. So any talks of stimulus, we really don't want that. And then runoff on the balance sheet, that's definitely going to help. First step is they're going to be stop the purchasing of the new mortgage bonds. Then they're going to hike the rates. And then they're still going to be rebuying bonds that sell off. So anything that they sell, they're just going to buy those back, but they're not going to be buying any new ones. So stock market forecast. This right here is really interesting. Stocks are very expensive right now when it comes to their earnings. So all of the stock market analysis, all of the people that are in the financial planning world are saying there's not a lot of good deals out there right now. And that's because everything's a little bit overvalued. So if you have money on the sidelines, if there is a dip, it would be a good time to invest at that time. So do not sell when they're low, always sell when it's high, but we may see a little bit of a dip in the stock market just because of the Fed's action here. There you go, PE multiple contraction, resulting in lower stock prices as seen in the past. Forecast probably a 10% decline in the stock market in the next year. So that's this, guys. This data I'm getting from is coming from one of the nation's most well-known and best predictors of interest rates and stock market. His name is Barry Habib. He's on all of the major networks talking all the time, and he owns a company called the MBS Highways, Mortgage-Backed Securities Highways, which every day gives me information. And he's the one that is helping me with this data. So just want to make sure you know where it comes from. This is not just me guessing. So interest rate forecast. What do we see happening this year? This is very important for your customers, but I want to show you what is going to happen after this year. So let's look first off with the stock market, and slower economic interest rates should head lower in the second part of the year. But guess what? 3.75 is what they're predicting it to peak to over this next couple months. But by the end of the year, we believe, and all the markets believe, that we should be at 3%. So rise towards 3.75% the first half of the year, decline towards 3% as the Fed rises rates towards the end of this year. So this is really good news, but bad news short term, good news further on. I'm going to open up to questions in a little bit, but so basically, we don't want to have anyone pay points for lower rates now because the opportunity to refinance is going to be very soon in the future. So if they have a rate right now at 3.75 with no points, they may be tempted to get that lower rate because they've seen that lower rate for so long. Don't do it, because at the end of the year, there will be opportunity to refinance that. It's a lot cheaper to refinance and pay points to get the same spread. So definitely, if you have people talking about points, have them talk to me. So housing forecast, this is really interesting, and I highly recommend talking to those people at the Cromford Report to get more data. But it will remain strong. It's a supply and demand issue, so it'll be slower, but in a softer rise because of interest rates. But it's still going to be a robust market out there. We're still going to see multiple offers on properties. Supply will increase, but remain tight. Tight labor, supply chain disruptions, semiconductor shortages, all of that, guys, is going to be playing a role in what happens with our market, but it's still going to be strong. We're still going to see an increase in appreciation between the 8 and 10%. So do not let your buyers go on the sidelines for a year because they could miss out on appreciation, even so. So increase will remain above 5%, pushing many people to see the benefit of buying. So mid to high single digit appreciation and still providing a great wealth creation opportunity. Absolutely. So that's a little bit of my breakdown as far as my overview of what's going to be happening in the markets this year, with interest rates, with the stock market, with what the Feds are doing. And I'm going to look at the chat to see if there's any questions. Bitcoin. Kim, you said you're wondering what's happening with Bitcoin. Well, Bitcoin supposedly is a hedge against inflation, but right now everything's getting clobbered. Bitcoin, I think, was down 6 or 7% this morning. The stock markets were down 500 or 600 points, and the bond markets were down. So everything's taking a hit right now, and I think it's going to be that way until we can stop the bleeding, so to speak. So I really think that Bitcoin is one of those investments that's a long-term play. If you're day trading Bitcoin, you may have a lot of heart attacks and aneurysms because it's so volatile. But I would say long-term play, that might be a good time to just watch it. If you know candlestick charts, watch the candlestick charts on Bitcoin. They are really, really telling. Any questions on what's happening with interest rates right now, or any of the changes and what that could do to your business? Don't be shy. Go ahead and jump on the chat if you want. Well, Angie, Angie with Pioneer Title is our sponsor, not sponsor, they're our partners. They don't pay anything. I invite them on here free just because I love them so much. Did you have anything to add to what you guys are doing this year as the new year, or anything coming up on your side?
Yes. Good morning, you guys. Happy New Year. I just put it in the chat, but we've, if you want to get started on your CE classes, we've got a Zoom class this Thursday, 1 to 3, agency law, but check it out. We do twice a month on Zoom. But Christy and I also wanted to let you guys know, most everyone on here probably has heard us talk about Aaron Hodson, and he will be back in town this Wednesday. So if you need more info, we're starting our new group this Wednesday morning, 9 to 10:30 at Sean and Christy's new office there at Scottsdale and Frank Lloyd Wright. So let us know. I'll put my info, I'll put Christy's info in there. But if you're interested, if you just want to come check it out on Wednesday morning, meet Aaron if you haven't so far, and just get your kind of year started off right with how he helps us and our agents. So anything you want to say about that, Sean?
No, if you haven't seen Aaron or talked with Aaron, he does have some really good insight on what the markets are doing. Remember, he was a realtor just like you. Now he's a personal coach, but he doesn't do coaching on the mass scale. He does it really individual. And he was closing 60 transactions as a realtor a month. So he knows what he's talking about. So if you want to pipe in to kind of learn what some tricks, what he has to say, definitely stop by. And I'm going to stay on this call for a little bit longer. If you guys have any questions regarding interest rates, etc., I will stay on. If you do have people that are pre-qualified over the last 6 months, guys, an increase in 1/2 to 3/4 in rate could push a lot of people way out of their price zone to what they can qualify for. So if they're in the 300 to 500 range and they were pushing the limits to qualify, those people need to be reevaluated with the new rates. It's very, very important, because a purchase price, an interest rate hike of about 1% is a loss of about $50,000 in purchasability. So we might have lost about $35,000 in purchase price. Any questions? All right, guys. Well, I'm going to stay on. I hope you learned from this call today, and we're going to, again, do it every Monday. So if you ever need anything from me, give me a call, and you can always reach me on my cell as well. So have a wonderful day, guys. Happy New Year, and we will be in touch.